The plunge in shares of Credit Suisse gripped world markets on Wednesday and renewed fears that a full-blown worldwide banking crisis might be brewing, prompting a radical move by Switzerland's central bank, which pledged financial support for the troubled bank if necessary.
Why are you guys running?
Reuters' U.S. finance editor Noun breaks down how we got here.
Credit Suisse's problems have been long-standing, so it's had a series of scandals over the last few years, including, management drama, on top of large trading losses because of its dealings with a big family office. And since the fall, it's been really trying to turn the ship around by launching a strategic review. It's laid off thousands of employees. So those are Credit Suisse-specific problems. Layer on top of that the fact that 3 U.S. banks have failed in the last week. That has really shaken the confidence of investors about the banking sector as a whole, focusing on the US, but now spreading to Switzerland. On top of that, we see that a famous sort of Saudi investor that had been underpinning and backstopping some of Credit Suisse's investments has now said it does not want to add to that stake. So in some ways, investors have seen that as a kind of a mark of a lack of confidence in contributing capital to the Credit Suisse. So all of those things added together have really hurt Credit Suisse's share price today. At one point, it was down 30%, and it's also prompted regulators and government officials in Switzerland to say that they're looking at it and they're going to take action if needed.
As Credit Suisse reeled, there was massive volatility elsewhere as bank stocks, yields on U.S. Treasuries, and Eurozone bonds, as well as oil prices, all plunged.
The reason why we see so much happening in markets today as a result of concerns about Credit Suisse probably originates from the fact that it is a globally systemic important bank. Systemically important in regulator speak means that this is a really big bank. It has a lot of interconnections across the economy. That includes stock markets, bond markets, sovereign bonds for many different countries. And so it just shows how large these institutions are and how important they are in the global economy. So anytime there's a knock to confidence, it will knock confidence across the board, across the global economy, not just in one narrow spot.
Credit Suisse would be the first major systemically important bank to receive such a lifeline from a central bank since the 2008 financial crisis. But Noun says it's hard to know if the broader crisis of confidence will be contained.
The real question for markets and investors is whether this is the beginning of a broader financial crisis. Right now, what we're hearing is that these problems are affecting individual companies, whether it's Credit Suisse or last week Silicon Valley Bank. The question is whether this knock to confidence is also going to start a self-fulfilling downward negative spiral that then leads to a full-blown financial crisis and panic.
Volatile trading gripped Wall Street Wednesday as fears of a banking crisis were revived. Stocks plunged sharply, then paired losses, with the major indexes closing mixed on the day. The Dow shed just under 1%, the S&P 500 shed 0.7%, and the Nasdaq closed up a hair. Trouble at Credit Suisse piled more pressure on the banking sector. U.S.-listed shares of the Swiss bank hit a record low after its largest investor said it could not provide more financing to the bank. But by the end of the day, Switzerland's central bank pledged to fund Credit Suisse with liquidity if necessary. The panic came just one day after shares of U.S. banks staged a strong recovery, with regulators enacting emergency measures to prevent contagion after the collapse of SVB Financial and Signature Bank. Some investors believe aggressive U.S. interest rate hikes by the Federal Reserve caused cracks in the financial system. Joy Yang, head of global product management and marketing at Market Vector Indexes, equates the Fed's policy with using a wrecking ball instead of a scalpel.
In using this wrecking ball, they can, kind of throw it at a target. But what we realize is that this ball is coming back. So some of, the damage that we're seeing now is really kind of what was happening from their intervention with, monetary easing. And so we've yet to see what's going to happen with monetary tightening and what damage is going to come out of that.
First Republic Bank tumbled more than 21%, while PacWest plunged nearly 13%. Trading was halted several times for volatility. Big U.S. banks including J.P. Morgan Chase, Citigroup, and Bank of America also dropped. U.S. Treasury yields fell, with traders now expecting equal chances of a 25 basis point rate hike and a pause at the Fed's meeting next week.
It makes about 70% of all iPhones, but Foxconn is suffering as demand for consumer electronics tails off. That could leave its giant factories looking less busy. The world's largest maker of electronics for other brands expects revenue for the first quarter and full year to be flat. For the final quarter of last year, profit fell 10% to about $1.3 billion, in line with forecasts. Now Taiwan-based Foxconn plans to respond with an overseas investment drive. It wants to win new customers, including car makers. The move comes after unrest late last year at a plant in China. Workers there were unhappy over strict health crisis restrictions. That sparked protests and prompted thousands of employees to leave, disrupting production at a key time of year. Now the company wants to build on existing efforts to diversify away from China. It also wants to avoid any problems related to the mounting tensions between Beijing and Washington. Other countries targeted for investment include the US, Vietnam, India, and Mexico. Right now, about 70% of Foxconn's revenue comes from goods made in China, but that share is expected to fall. The firm didn't put a number on the scale of its planned overseas investments.